Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Welcome back to ETF Market Insights. I'm Erin Allen with BMO ETFs, and today we're getting into the topic of commodities. These are the raw materials that go into production and manufacturing and really everyday life, and we're going to break down how these fit in an investment portfolio, the drivers of return, and the different ways that you can access commodities in your portfolio. We're also going to introduce our newest ETF, ZCOM, the BMO Broad Commodity ETF, so more to come on that. Before we get started, a quick reminder, we're not providing any investment advice or recommendations. As always, these videos are about education and information for the DIY investor. Joining me today, I have Jimmy Xu, Portfolio Manager with BMO ETFs. He's also the head of liquid alternatives and non-linear, or maybe more generally what we know as options-based ETFs here at BMO Global Asset Management. So Jimmy, welcome to the channel.
Thanks for having me.
It's good to have you. I'm looking forward to learning more about commodity investing. Maybe I can just have you sort of kick things off with an intro in terms of what we mean when we say commodity investing. What does it include? And really, broadly speaking, how investing in commodities may differ from traditional equities and fixed income.
Yeah, absolutely. When we think about commodities are really make up the building blocks of the economy that we interact with every day. Commodities are fundamentally different than traditional asset classes like fixed income or equities. They're inputs to things that we consume, things that we eat, things that we use to power our cars. When you think about investing in equities, what drives equities returns is, future earnings. If future earnings goes up, then your equity prices tend to go up. With commodities, it's very different. What drives the price returns of commodities, typically governed by supply and demand, that has ties to the real economy, which is why commodities typically has a very high correlation to inflation, and many investors use commodities in a portfolio context to both hedge against inflation and also to diversify against unexpected inflation for their bond and equities.
Awesome. And we have a nice illustration that we've put together here that shows sort of what you characterize as the three drivers of commodity returns: price return, roll return, collateral return. Can you explain these for us and get into sort of how these may impact the investor's outcome at the end of the day?
Sure. I think one of the biggest differences between investing in commodities versus other asset classes is that when most people invest in commodities, they don't actually hold the physical commodity itself. Outside of something like gold, if you wanted to get exposure to, let's say, oil, you typically don't hold barrels of oil in your inventory in your portfolio. So how most investors gain access to commodity is through commodity futures. So commodity futures gives you exposure to the commodity's price movement without actually having to hold that physical asset, which could be very challenging for almost every investor. So when we're dealing with commodity futures, there are really three drivers of return. So first is the price return. So the price return simply comes from the changes in the commodities, the underlying commodities price. For example, when oil prices go up, then the price return of that commodities future also goes up. And it's really typically driven by, as you would imagine, supply and demand. The second driver of commodities is roll yield. Roll yield refers to the fact that since we do hold futures exposure to commodities, we have to roll the futures exposure when the futures mature because we never want to take delivery of the underlying commodities. So when we replace one futures contract with another futures contract, there is a price difference between the two. And that's driven by things like storage cost, supply and demand, hedging demand from producers and consumers of commodities, and sometimes it can be positive, sometimes it can be negative. And finally, there's also the collateral yield, which really represents the cash interest earned that backs your commodity futures. While this does sound somewhat complicated, there's lots of moving parts, but all investors all need to remember is that over the short run, it's the changes in commodity prices that will dominate the investor experience. But when they hold commodity exposure over the long run, things like roll yield and collateral yield becomes a more important part of their overall total return experience.
Yeah, ETFs have really made it simple for investors to get access to these things, right? I think having somebody do this on their own would be quite the task, and so it's a great
Yeah,
innovation.
almost impossible, I would say. If you look at the broad Bloomberg Commodity Index, there's 24 commodity features. They have a very specific role schedule, a role and role methodology. And if you forget to roll a features, you might get live catalyst delivered to your front door. So it's very difficult for most investors to gain direct access to commodities. And this is where the ZCOM ETF can bring lots of value. It's a one-ticket solution that gains access to 24 broad commodities across the index in a very cost-effective and easy-to-access way.
So you don't need to get a bigger backyard to host all of your livestock that's going to be getting delivered. I got it.
That's right.
Commodities are, often described as having long cycles because supply and demand adjustments take time. And like unlike consumer goods, for example, you can't ramp up oil production or create a new mine overnight. So these processes obviously can take years. It means commodity prices tend to move in longer phases. So can you talk to us a bit about that and share some examples of short-term and long-term factors that might shape the commodities market more recently?
Sure, absolutely. One feature of the commodities market is that it is a physical asset. And as you mentioned, Aaron, if you want more oil, you have to drill, baby, drill, as some presidents would say. And if you look at over the last 10 years or so, there has been a lack of investments into mining, into production of commodities as a whole. And when we fast forward over the next 10 years, we're seeing longer term macro trends that are fairly supportive for the demand side of commodities. For example, infrastructure building requires commodities, greenification requires much more copper than we have ever used in the past, investments in data centers, AI, defense spending. All these demand trends are not going away. They're going to be persistent for the next little while. And on the supply side, because there's been underinvestment in the commodities sector as a whole over the last 10 years, supply side is quite constrained. And if you want to bring out a new copper mine from dirt into getting copper actually out of the ground, it takes more than 10 years. So the supply side is quite inelastic. What this means is that when we look forward the next 10 years, I think it's a very bullish environment for commodities. And the ZCOM ETFs gives investors a way to access these macro trends in a very efficient way.
Yeah, it sounds like there's some really big themes that are going to drive demand going forward. A lot of investors, I think, ask the question when it comes to commodities, why not just buy the commodity stocks, buying shares of the actual companies involved in that commodities production, instead of, directly investing in the commodity exposure as we've created with something like Zedcom. Can you talk about the key differences there and the portfolio implications?
For sure, there's some really fundamental differences in investing in commodities versus investing in commodities equities. Obviously, when you invest in commodity equities, you do get some exposure to commodities. The revenues are tied to the price of the underlying commodity that they're producing. But for commodity producers, there's also other aspects that comes into play. For example, how efficient do the companies operate their mines? That has a big implication on the pricing on the valuations of these commodity stocks. So operating efficiency, capital structure, these also impact the price of commodity stocks. And commodity equities is fundamentally still equities. And when you look at the drivers of commodities stocks, equity risk premium. It moves generally with the broad equities market. So it's not as diversifying, as direct of an inflation hedge compared to physical commodities. And one thing to remember, people often use these commodities or commodities equities as inflation hedge. But for a commodities producer, when there's inflation, the cost of producing that commodity also increases. So that direct hedge against inflation is not as strong. Whereas direct commodity itself, it tracks the actual cost of the prices of these physical goods. So they tend to have a much more higher correlation to inflation. They're much more reactive to inflation compared to the commodity stocks.
Okay, good. That's a good overview. Let's get into portfolio construction. Talk to us about what the evidence shows about adding commodities to a portfolio. What are the benefits of it?
Yeah, the biggest benefit of adding commodities to a balanced fund is its overall diversification. So if you add a commodity allocation to your overall portfolio mix, you can reduce the portfolio overall volatility over the long run and make your portfolio overall more resilient to inflationary shocks. And I think the best example of this is what happened in 2022 when inflation, the US CPI, peaked at just over 9%. And during that period, S&P was down 20%, Canadian bonds were down 17%, and even inflation index bonds were down 20% as well. However, the Bloomberg Commodity Index, which is what the ZCOM ETF designed to track, was up 16% in 2022, 27% in 2021. These are all in US dollar terms when inflation began to rise post-COVID. So you can see, commodities, by adding commodity exposure to the overall portfolio allocation, not only can you take advantage of the macro trends that's happening in the marketplace today, but also helps to diversify against unexpected inflationary shocks and reduce the overall risk of your portfolio.
For sure. And I love the diversified approach of ZCOM. We launched this in record speed. I think we got it to market. There was demand for it in about 5 weeks. So walk us through sort of what was behind that, and then talk us through sort of BMO's broader commodity exposure and what we have to offer investors.
Absolutely. I think this is probably one of our fastest ETF launch that we've ever um, that I've ever been a part of in a very short period of time. The HUN AUM, the ETF AUM is about 440 million. So as you can see, like the demand for commodities is certainly there in the marketplace. And if you think about the users, some of the client base that's investing in the commodities ETF, they are using it as a part of a multi-asset portfolio for the purposes that we just talked about. Obviously, ZCOM isn't the only commodities that BMO Global Asset Management offers. We have our ZGLD, our gold bullion ETF, which gives investors direct exposure to physical gold bars stored right in this building. And as we know with gold is an asset that doesn't generate any yield. It just sits there. Um, for yield or income focused investors, we also have ZWGD, which uses an options overlay strategy to generate a cash flow out of a yieldless asset. I think for long term investors, it's a really great way to access gold. For commodity equities, we have a wide breadth of commodities equity exposure from gold producers, junior gold producers, energy producers, base metal miners, and agriculture. And obviously, we also have a cover call version of our energy producer ETF as well.
Some might say it's a huge suite of commodity-focused ETFs. I think there's really a lot of options here, and I love how we're giving investors flexibility to target the equities, target the physical assets. It's great to see all of these innovations come to market. So thank you very much, Jimmy, for that overview. I really appreciate it. You've given us a lot to chew on for as we head into the weekend here, and I hope you'll come back again soon.
Thanks, Aaron.
That's all for today. We will see you next time. Bye for now.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.